the market feels good about some kind of strong stimulus that comes fast. If we don't get something like that, what are the risks that could really unravel here in the market?
Well, I think you're going to get something. I think the most important right now, given what was done in December, where we passed $900 billion of additional aid, most of that program that affects individuals, households, renters, and the like extends into March. And the new Biden proposal takes a bunch of those programs, unemployment insurance, payments to individuals, renter relief, and would extend them out to September. But I think the primary focus in his first week in office has been on making sure we get the vaccines out and that we ramp up testing, something we've been pretty bad at doing over the last year. And so I think that those parts of the bills will get passed very quickly. The money for vaccines, which is about $20 billion, and $50 billion for testing, and hiring 100,000 new healthcare workers to make sure the tests and the vaccines get done. I think that part of it will probably enjoy broad bipartisan support. The urgency for the renter assistance and extended unemployment benefits, and for the direct payments to households, that stuff I think will take longer to get through Congress, as will the aid to states and localities.
Speaking of unemployment, it's still quite elevated. We're seeing the market rally, waver now, but generally rally. What are investors ignoring about the economy right now that might come back to bite them?
Well, listen, for a year, we've been struggling with a global pandemic in the United States. 400,000 people dead, more than 25 million Americans infected. Until we get the virus under control, it's going to be choppy economically. We're sort of living in a tale of two cities in terms of the economy. The travel-related businesses, hospitality, retail, restaurants are all hurting because of the social distancing. And that represents a significant chunk of people in the employees who have lost their jobs. And where they still have jobs, where demand for their services is very low. By contrast, you've got other parts of the economy, the technology sector, communication sector, and financial services that are doing just fine. But the part of the economy that has been shut down or impaired by the social distancing and dealing with a real pandemic, a real issue for public health, are going to struggle until we get the virus under control. And that's just the reality. There's been a false dichotomy between, shutting the economy down and dealing with the virus, promoting the economy or promoting public health. These two things are completely linked.
So when we talk to your peers, Jim, there's been a big expectation that a lot of the debt loads the companies have taken on their balance sheets will also come back to hurt them sometime this year, next year. How are your clients working through this right now?
Well, right now, there's obviously tremendous liquidity in the debt markets. Non-financial corporate debt is up $2 trillion over the last year to the highest level in American history. But the debt is cheap. The Fed has kept rates low. Investment grade debt averages, 2% yield. I mean, you've never been able to borrow this much money at such concessionary rates. So debt service ratios are really not that bad, even though debt levels are the highest they've been in corporate history. So as long as the Federal Reserve is making liquidity plentiful and keeping a cap on rates, the corporate sectors that have taken on more leverage to create more liquidity, to create a longer runway to get through the end of the pandemic, should be fine. The real question is, when we get to the end of the pandemic, as we get, I hope, to the end of this year and things are reopening in full, whether the revenues come back in a way to support these new capital structures, these much more highly levered capital structures. And I think that's going to be a case-by-case basis, depending upon how much of a bounce back we get in revenues.
Jim, good morning. It's Guy. Thanks for your time today. To that point, when we get through this phase, we get to the phase you're talking about, what do you think default rates are going to look like in the loan market?
You know, it's hard to generalize. Look, I think all the major rating agencies have taken their projected default rates down, almost cut them by half. Earlier in the third quarter of last year, they were projecting 7 to 8% default rates across the corporate sector, and now they're down to the 2 or 3% default rates. Nobody really knows. It really depends on, you know, which industry you're in, how much leverage you've taken on, and how fast revenues come back.
Do you think there's any risk? Do you think any of this is systemic? You take a look at the CLO market, you wonder exactly which banks are holding what and which tranches they're holding. If we were to see default rates, say, moving north of 10%, which I think is the historic high in that sector, do you think there would be any systemic threat to the system?
No, I think, listen, I think the reforms of Dodd-Frank have really stabilized the financial condition of the banking industry. I think the banking industry is highly capitalized and has much better liquidity protections. The truth of the matter is our financial system has really evolved, and we've seen that in the extraordinary actions the Fed took. This time around, you know, the Fed wasn't really intervening in the bank market. The Fed was intervening in the bond market. The bond market today is, you know, 70% of lending to the corporate sector. The banking sector provides, you know, about 20% to the corporate sector. So if the corporate sector wobbles, given the better capitalization and regulation around the banking industry should be fine. It's really the bond market. The bond market, it provides the bulk of the funds to the corporate sector. That has been, you know, the real difference in the financial system over the last 20 years is just the phenomenal growth of the corporate debt markets.
Mm-hmm. Well, yeah, and the government debt also. At what point is that bad? I mean, there's two schools of thought, right? I mean, one is that debt never really comes home to roost, right? You can just keep on rolling it over if you're the U.S. government. And the other is that at some point, it's going to be too much debt to take on, and particularly when it comes to, say, states. What do you think?
Sorry?
I was saying that, what about government debt? When does that become a tipping point for you?
Well, look, it's already the highest level it has been since the end of World War II. I mean, we have added $5 trillion worth of debt during the course of the Trump administration, and we're running a kind of structural deficit right now of about $2 trillion on a $6 trillion budget. So we're the fiscal numbers are really astounding, but we are in the middle of a recession and a public health care crisis. And this is not the time to start wringing our hands about the federal deficits. There will need to be, out in 22, 23, 24, a fiscal adjustment plan for the federal government. We can't be running $2 to $3 trillion deficits. You can't be running deficits at 15% of GDP. Eventually, bond investors are going to lose confidence in the ability of the federal government to manage its own finances. But for the moment, with the Fed actively buying the government's debt and expanding its balance sheet, you know, the Fed is the buyer of last resort in the federal debt market, and they're keeping rates low to keep debt service ratios low for the federal government, so as to facilitate the federal government's intervention to deal with the clear distress that's out in the economy.
Jim, we look at you for a dose of reality here. If there is anything that worries you right now, what is it?
Well, I have to say that I think that what this crisis has revealed is the is the need for innovation in the manner in which we deliver services to the people, and in the financial architecture. You know, the Fed has, for the second time in 10 years, had to use its emergency powers to intervene in the financial markets in order to stabilize financial conditions. And the truth is, they don't really have the tools or the supervisory authority over the bond market. And the bond market has become the most important source of capital to the corporate sector in the United States. In March, when they created their new corporate credit facilities, thankfully they didn't have to use them much. The mere fact that they were there spurred an enormous rally in corporate debt. And as we said, huge, record amounts of investment grade and high yield debt were raised on the backs of that Federal Reserve emergency program. But the fact that they need to intervene from time to time in the bond markets in order to stabilize financial conditions and ensure orderly credit formation, and that they only have emergency powers to do it, suggests to me that we have long overlooked the need to innovate the financial architecture governing our bond markets.